With markets reeling from historical levels of volatility in the week just gone by, we have at least seen Donald Trump provide a 90-day reprieve on the reciprocal tariffs for all countries apart from China. That still does leave a raft of tariffs in place. Certainly at least gives us some breathing room, and we saw a massive pop in terms of equity markets. Well, for the week ahead, we've got a raft of interesting releases and reports to look out for, with the likes of the ECB and the Bank of Canada both announcing their interest rate decisions, alongside a raft of Chinese data points coming at a key time. We've also got some figures coming out of the UK. So a particularly busy week for the week starting Monday, the 14th of April. So let's get into it. These are the big ticket items according to Trading Economics. You can see on Tuesday, we kick off with meeting minutes of the RBA, followed by the jobs report in the UK, ZEW economic sentiment survey, and then inflation out of Canada. Wednesday, we've got GDP, industrial production, retail sales, and more from the Chinese region. That's going to be key. We then have the inflation report out of the UK. Now, bear in mind, I will try to drop a separate video for the inflation report for the UK, just given the fact that I could only choose 3 out of the 4, and I've dropped the UK one so I can focus on that separately. But alongside that, we've got retail sales from the US, the Bank of Canada interest rate decision. Thursday's got the ECB rate decision, and Friday sees the inflation report coming out of Japan. Now, let's kick off with the Eurozone. The Eurozone, of course, has celebrated this delay in terms of the 20% tariff that was expected to be implemented by the US. Donald Trump ultimately bowing to pressure of the bond market and saying that he's going to delay that by 90 days. Now, that saw a rally of roughly 5% from the DAX. Are we going to see more? Is this the bottom? These are the key questions that need to be answered. Ultimately, the thing here is that, number one, we haven't got a trade deal between the US and the EU. So there still is that hurdle to overcome. So there's still uncertainty on that front. We've got the 10% tariff that's coming into place, and the potential for the Eurozone to enter into a tit-for-tat trade war with the US if they return in kind. We also have the 25% tariff on autos from the US, and the potential for a similar kind of tariff coming into play for pharmaceuticals, which is something that Donald Trump has alluded to after saying about the 90-day reprieve. So there's still plenty of question marks around the Eurozone for the time being. We can see here that in Tuesday, we've got industrial production, ZEW economic sentiment out of Germany, industrial production. So we'll get some interesting data points there, but really it's that ZEW figure because that's an April figure. So you really want to be looking out for the figures, the data points that are very timely and very recent. The historical ones aren't really going to be of much use because things are changing quite a lot at the moment. We want to see how people are reacting to the tariffs, or at least preparing for the tariffs as we get close to it, or we got closer to it. Later on in the week, we've got that inflation report, but it's the final figures, so it's unlikely we're going to see a huge amount of movement. You can see here also on Thursday, we've got that ECB interest rate decision with a expectation of a 25 basis point cut to be enacted. As we see here, according to Refinitiv, the expectation is for a 96% chance that we see that 25 basis point cut. And then from there on out, we can see another cut expected in June. And then the month after that in July, not expecting much. Then we see a likely cut or potential cut for September. And then from there on in, that could be it really. 175 currently what markets are pricing in as the sort of terminal rate or the neutral rate, so to speak. And the proximity to that sort of endpoint is going to be increasingly important as we go forward, with the perception of the ECB over how much further they need to go likely to prove key. Of course, I've highlighted in the past that FX pairs can often be impacted by sort of relative movements in terms of bond yields, 10-year yields and the like. And that is impacted by the movements of the central banks. So the ECB, once they stop cutting interest rates, you could see the possibility of euro strength as we see other central banks that haven't cut as much then starting to ramp it up. So we have actually seen a spike in terms of euro sterling of late. Nonetheless, I wanted to talk about the DAX because this is my chance to talk about equity markets. First and foremost, this is a look at the PE ratio for the DAX. And so, this talk that we have been having about markets being overvalued or historically very expensive, this recent pullback has provided us with the basis for us to say, maybe it's not necessarily all too bad right now. But nonetheless, things have been changing because we've seen that big pop around the announcement from Donald Trump that we are going to see a 90-day break, a pause, and give some time to find a trade deal. It's notable that if you want to strike a trade deal with pretty much every country in the world, including islands full of penguins and seals, you probably don't want to give yourself a couple of days to complete all of them. And it seems like Donald Trump's realized that. He's also been pushed into it by the bond market, because what we've seen is a spike in terms of treasury yields. And we'll come on to that later on when we talk about China. Nonetheless, this is the chart for the DAX. I mean, there's two sort of potential trend lines I was going to draw on here. I guess there could be three, right? So one would be the one that I drew there, another one could be there, and another one could be here, right? So in any case, all of them have got two touch. They haven't got a third, but we've now got a third on this one. So we now know that's the sort of trend line to look out for. In essence, I mean, ultimately, you're looking at, whether it's one or the other of those trend lines, you're sort of pointing towards the fact that this uptrend that's been playing out here sort of points towards this zone, this sort of region with those three that are drawn in, sort of creating a fan of support. That zone being the area where we could potentially bottom out. Notably, it's around that 76.4 fib, in that deep fib zone. So that looked like a really interesting area to be looking for this market to potentially hold up. That's how it has played out. Now, it dropped 20%, very close around that 90-day announcement, and then crucially starting to pull back on a Thursday. And here's my point, right? As I've noted previously, we're not out of the woods. There's still a lot of things that need to be ticked off in terms of a trade deal, in terms of knowing that the Eurozone economy is not going to be in a complete mess with these tariffs that are being enacted. What's the impact of the 25% tariff on autos? Are we going to see retaliatory measures coming from the EU? Are we going to start seeing a trade war? There's still a lot of questions. So, there's a lot of people that will look at that spike and say, I've missed the bottom, time to jump in because we're going to go back up to the all-time highs. It's not going to work out like that. Certainly not in my mind, because then ultimately it could happen for the US, probably more likely than the Eurozone, because the US are looking to strike deals that are going to be positive for the US economy. The Eurozone, if they strike a deal, they're probably going to be giving something away, because this is a case of trying to close the gap, so to speak. I don't necessarily think we're going to rally back up to record highs right away. Doesn't mean we can't. And so from an investor's mindset, you could say I could get long right now and, hold on for a bit. But if you're looking at this from a trader's mindset, if you're looking at that sort of massive rally, the pullback we're seeing today highlights the fact that we're likely to see some jitters, and it's not going to be a straight line move back up into record highs. Do I think we've bottomed out? I think most likely. And the reason for that is that ultimately, if you're looking at the huge uncertainty previously, a lot of that's gone away. Part of that uncertainty was this 20% tariff. Part of it was the potential for the Eurozone to ramp up this tit-for-tat trade war. Well, that's less likely now, because we've seen that 20% averted, and so they're kind of in the same boat as everyone else. So they're probably not going to, they can save face a little bit on that front, and partly because they've got the time to actually strike a deal. So if we don't see a massive trade war taking hold, and ultimately within the next 3 months, we're just waiting around for a trade deal, then great. What's the other scenario that could really hurt not just the DAX, but sort of global markets? Well, it'd be a potential ramping up of the trade war between the US and China. That is already very ramped up, to say the least. And, maybe it gets worse. But the fact of the matter is, we've already got 125% tariffs. How much worse is it going to get? Even if it went to 150, I don't think markets are suddenly that's the point that we're going to think it's a massive deal. Of course, you've got the potential for inflation rearing its head because of those that breakdown between the two countries. But certainly for me, I think that that is the low. And I think that near term we could pull back into a retracement. And so, where are we going to be looking for the bull to come back into play? Well, we've come into a sort of mid-sized retracement as it stands. Trying to get that up, but let's see what have we done. Yeah, so we're roughly the 50% fib. So near term, if we pull back, I think there's a good chance that we hold up and start to rally once again before we come into this 193 or 19,300 support level. But like I said, I think there's likely to be some choppiness. I think it's likely to take some time. If we pull back, I think, the deeper pullback gives potential opportunities for the bulls. And we'd need to break through these recent support levels, 19300, 18811, for me to start thinking we could see further downside. But, for the near term, we could see a little bit further weakness. But I do think that we're gradually going to start finding a little bit more of a positive footing, in particular if we see an announcement coming out stating that the US and China are trying to find an agreement, blah, blah, blah. That kind of thing. So Canada, we've got inflation coming out on Tuesday. We've got the Bank of Canada interest rate decision on Wednesday. In terms of inflation, there's an expectation that we move a little bit higher in terms of core, a little bit higher in terms of headline. And, what's going to be really interesting here is what the Bank of Canada do. Now, they're at 275, and at the moment, it looks like they're going to stand put. It looks like they're just going to remain steady. As we can see here, there's a 60% chance, according to Refinitiv, that we do exactly that, with the rate cut likely to be taking place in June. So potentially a sort of slower pathway lower. You can see beyond that, the next rate cut is priced sort of roughly for the back end of the year. So, we're kind of also getting to the point where the Bank of Canada also ease off on their easing. Certainly, the position that we had seen the US-Canadian relationship in, compared to where we are at the moment, it certainly feels a lot better now than it had done previously. And so the Bank of Canada are under less pressure. The Canadian dollar could be under less pressure. But of course, you also have that tie-up with the likes of the Canadian dollar and oil prices, which have been heading sharply lower. This highlights the importance of that relationship. So we have the light blue line in the middle, where the percentage of GDP is reliant on exports to the US. And you can see here roughly 20% for the Canadian economy. So that relationship is absolutely massive. It's crucial. And it feels like Donald Trump has softened his stance over the last 24 hours, 48 hours, depends when you watch this video. But ultimately, it feels like he softened his stance. That is a positive to be taking away from it, and makes it less likely that the Bank of Canada are going to be cutting rates. Now, interestingly enough, this plays into this narrative around a potential pullback for dollar CAD. We've seen this double top formation, so weakness for the US dollar, strength for the Canadian dollar, and it plays into this wider trend that we can see here on the daily time frame. If I show it on the weekly as well, we can see it here. So weekly time frame highlights the idea that we could get back down towards the sort of 138 mark. So there could be near-term downside coming into play. Of course, we've also got this sort of area of resistance around that area as well. So if we were to sort of put a horizontal line on, you'd be looking at this kind of zone here to also potentially come into play. So, sort of 138.5s kind of area, I think could be quite interesting if we sort of come back down to it. Do we sort of bottom out there? Potentially, but I think this is an interesting one to be watching over the near term. We're seeing some wide swings, but now that we've seen some clarity coming into play, I won't be surprised on an intraday basis to continue to follow this trend of lower highs, lower lows. And keep an eye out for this Bank of Canada interest rate decision. Like I said, it's all about the neutral rate, or essentially the rate at which they stop easing interest rates. And what's their perception of the economy in the face of the current state of play for US-Canadian relations. Finally, let's look out for what's happening in China. China is absolutely massive at the moment because, whilst we came into this period with Donald Trump in the White House once again talking about, he seems to be quite preferential to the Chinese in some ways, talking about a potential massive trade deal between the two countries. Well, soon enough, we're back to where we were in his first stint in the White House, where it's all the other countries are now sort of in a much better standing, and China are very much in the target line for the US. But the Chinese are trying to fight back, right? They're not rolling over. So it's going to be particularly interesting, and it has knock-on implications across a raft of markets, how this plays out. So Wednesday, we see this whole slew of economic data coming out of China. GDP growth expected to slow. Industrial production expected to slow. Retail sales expected to slow. This is all March data. GDP's Q1. Industrial capacity utilization expected to weaken. Unemployment rate expected to decline. But by and large, a relatively weak report expected. And there's big questions around the Chinese economy. But the way that I see it at the moment is we're being guided in a certain direction by the government and by the PBOC. And essentially, they have it in their interests to weaken their economy, or will not weaken their economy, weaken their currency. Because, of course, if you enact tariffs, then you can weaken your currency in the opposite direction, and then you essentially eradicate the implications of those tariffs to a large extent. So this is one thing that's been going on, right? So this is the holding of US bonds, US treasuries from Japan and China. It's a long-term view. So this is a long-term pattern that's playing out here. But essentially, we've seen a decline in these two countries, who are two of the biggest holders of treasuries in terms of foreign nations. And so you're looking at, again, the possibility that they continue to dump treasuries, raising the yield. That's what we've seen recently. Donald Trump has alluded to the fact that he's given us this 90-day reprieve because of exactly that. And so this is a Trump card, excuse the pun. This is the thing that the Chinese could potentially use. So it's worthwhile looking out for, because it has knock-on implications in terms of the value of the US dollar and alike. And so borrowing costs could be moving higher if the likes of the Japanese and the Chinese continue to dump US treasuries. Alongside that, the Chinese are holding back on rare earth materials or minerals. That's absolutely key. That's another Trump card. They're also apparently going to ban Hollywood films. But the part we want to talk about here is the potential for them to devalue the yuan. Now, if we look here, what we've seen in terms of the previous stint in power was that the original part of Donald Trump's sort of tenure in the White House, we can see in actual fact, we saw weakness in terms of the US dollar, weakness in terms of the Chinese yuan. So both of them moving lower, as you can see on that grey box on the left-hand section of it. But once we started to see the trade war between the two really ramping up, we ultimately saw a swift turnaround, and in particular, a swift turnaround for the US dollar against the Chinese yuan, which we saw really strong moves higher. We saw Donald Trump essentially accusing the Chinese of currency manipulation. And then what's happening at the moment? Well, what's interesting is we're seeing weakness in terms of the US dollar once again, but actually we're seeing strength in terms of dollar yuan. And so that highlights the idea that the Chinese are seeking to weaken their currency in a bid to do something similar to what we were talking about, right? It helps them from an export perspective. So let's look at it in terms of the chart. This is, let me just grab it here. This is the chart for the US dollar index charted against the dollar against the yuan. So that decline that we're seeing here in terms of the dollar index, not necessarily happening in terms of yuan. Instead, dollar yuan popping higher. Now, we've seen a pullback on this breakthrough announcement, but nonetheless, the pattern here is for a divergence between the two, which is not the norm. So you can see here, it's almost as if they're guiding it in that direction against the trend that we're seeing elsewhere. So weakness in terms of the yuan does look likely to persist. The potential for this pullback to provide an entry opportunity. There is a potential that if we see weakness in terms of the economic data, it provides that weakness for the Chinese yuan. It points towards further stimulus needing to be implemented, which they've essentially promised going forward. But if we do see a trade deal coming into play, there's a possibility we see a bit of strength coming into play for the Chinese yuan. But certainly, I think for the week ahead, this is going to be a really interesting one to watch. That divergence between dollar index and dollar yuan highlights the idea that essentially it's in the Chinese interest to weaken that currency. And we've been seeing really significant moves of strength for the US dollar against the Chinese yuan recently. Wouldn't be surprised to see more as we go ahead. But certainly those trade talks are going to be absolutely key. If we see a sign of a potential breakthrough, that could shift the narrative quite significantly. I hope that has helped. Like I said, I'll try and make a standalone video for the UK inflation report, likely on Monday. Other than that, have a great day, have a great weekend, and a great week ahead. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Thank you.